and welcome to IIFL Markets. Let us look at our expectations from the oil and gas sector for the fourth quarter. We expect a good performance from the oil and gas sector in all key segments. Prices of Brent crude oil and LNG have risen by 24 and 30% respectively on a sequential basis. Consumption of petrol, oil, and lubricants, though, was down in the quarter due to the reimposition of lockdowns in some places and high pump prices. We expect sales volume to decline by 6 to 11% for the full year. On the quarter, however, upstream companies such as Reliance, ONGC, Oil India, and GAIL will benefit from favorable commodity prices. Inventory gains and recovery in gross refining margins should boost earnings of oil marketing companies, IOC, HPCL, and BPCL. We expect highest earning growth for HPCL while lowest earnings growth for Oil India. This is due to high earnings in the base quarter for Oil India, which was on account of tax write-backs. City gas distribution companies or CGD companies will have another strong quarter amid robust volumes and healthy margins and could post an earnings growth of 14 to 51% on a YOY basis. Let us look at each of these segments individually. Upstream. Crude oil realization for ONGC and Oil India is set to rise by around 20% on a YOY basis and will be further aided by depreciating INR. For ONGC, the rise in realization will be partially offset by lower volumes. ONGC's production is expected to be down by 2% on a YOY basis. Oil India's production is estimated to rise by 1% on a YOY basis on a low base of last year. The company's net profit, though, could decline 41% due to a tax reversal in the base quarter. GAIL's gas trading business is expected to turn around in the fourth quarter and generate EBITDA of Rs 1.5 billion versus a loss in each of the last 3 quarters. Sharp surge in spot LNG and crude prices will fuel this turnaround for the company. GAIL's profit before tax could decline 2% YOY on account of strong gas marketing and LPG EBITDA in the base quarter. Oil marketing companies. OMCs could post subdued marketing margins and witness reduced product demand hit by the lockdown. However, we expect the marketing margin to fall 40 to 60% sequentially below normal levels. This weakness, though, will be more than offset by the rise in gross refining margins. OMCs are also expected to benefit from the inventory gains arising from an increase in crude oil prices. Earnings are expected to decline 20 to 39% on a sequential basis due to weak marketing margin, but are likely to rise sharply on a year-on-year basis. This is because OMCs had posted a loss at the profit before tax level in the base quarter of March 2020, which was hit by weak GRMs and inventory losses. City gas distribution companies. We build in a 7 to 20% year-on-year rise in volumes for CGD companies, with Gujarat Gas likely to race ahead of its peers. Margins of CGD companies are likely to remain strong on the back of a fall in APM gas prices. Gujarat Gas is likely to post a sequential decline in the EBITDA spread due to the run-up in spot LNG prices. Overall, we expect a 14%, 33%, and 51% YOY growth in profits for Gujarat Gas, Mahanagar Gas, and Indraprastha Gas, respectively. Reliance Industries. In the oil to chemicals business, throughput is expected to be down 13% on a YOY basis and 4% sequentially due to reduced demand. O2C business EBITDA is expected to be strong at Rs 115 billion, up 69% on a YOY basis, due to strong GRMs and petrochemical margins. Thus, the O2C business is expected to post strong growth in earnings driven by margins and will offset the subdued volumes. Standalone entity is expected to post net profit a growth of 2.3 times on a YOY basis. RIL's consolidated earnings are likely to surge by 116% on a YOY basis, driven by the O2C business. Amongst its other businesses, Reliance Retail is poised to see 10% sequential higher sales and EBITDA respectively. Performance of Jio would remain strong with a net profit rising by 43% on a YoY basis. We have raised Reliance's FY21 and 22 estimated EPS by 5% and 2% respectively to take into account the strong OTC performance. Thanks for tuning in. If you like this video, subscribe to IIFL Markets.